Lesson 11, the dynamics of option prices. This is a very interesting one, I promise. Here what you will learn here, how do option prices move, of course, before the expiry, and elasticity and leverage of options. Virtually all the concepts seen so far apply to the expiration of contracts. Now we will deal with what happens when we move during the life of the options, therefore on any day between the current day and the expiry date. In the next slides we will go into much more details about the premium, and we will introduce intrinsic value, time value, and the variables that affect them. We will also talk about elasticity, which is the reactivity of the option price with respect to the underlying, and the leverage. Generally speaking, the leverage of a financial instrument is given by the ratio between the profit obtainable against a certain price movement of the underlying and the money needed to obtain that gain, compared with the same ratio in the case in which the investment was made without any leverage, that is, directly buying the underlying. In other words, the leverage is a measure of how many times the profit is amplified thanks to reduced need of money to take the trade. In the field of futures, an example already seen before, if we buy 1,000 shares of a security at 10 euros each without a lever, we spend 10,000 euros. If the price goes to 11, we gain 1,000 euros, 10% on the money used. The same investment made with the stock futures having 1,000 shares lot, which requires 10% of the margin, results in 100% profit on the money investment. Same movement in the share price, 10 times greater profit with the futures. This is thanks to the margin and what comes with it. In the world of options, given the same trade as before and the same profit of 10% on the underlying, if we use a call strike 10 euros with a lot always 1,000 shares, which compared to an initial cost of 1 euro rises to 1.6 against the same movement of the underlying, then we earn 600 euros against the 1,000 invested, for a profit of 60%, 6 times greater than that on the underlying. Now a question arises, why the price of the futures follows the underlying one-to-one and the price of the option doesn't? The point is that not all options have the same reactivity as the spot price varies. This fact is also reflected in their leverage. Generally speaking, in the money options have greater responsiveness than at the money and out of the money, but at the same time they have a less leverage, and vice versa. To prove this, we need to look at the typical chain of options, namely the matrix that shows all the options listed for a specific underlying, divided into tables, one for each maturity. These tables are symmetrical. In the central column the strikes are shown, on the left we have the calls, on the right we have the puts. See next slide. The next sentence could be very puzzling if you do not look at the option chain. So let's first go to the next slide and take a look at the chain and then come back and read what's written here. This is a typical chain. Indeed, I recreated it because in a real option chain you have much more information than the one you have here, but I wanted you just to focus on the strike prices and the price of the options. So the following chain shows the option on the FTSE MIB index captured at a certain date. The expiry is about 2 months away. We can see it here, 64 days. And the price of the underlying in the moment of capture is around 17,680 points. Okay, so look at the table. Here we have the strike price in the central column. They are sorted from bottom to top, and they are distanced 500 points each. The distance between the strike prices listed is decided by the issuer, the stock exchange. Usually they are set every 100 points. For weekly options, they are set at 250 points distance for the near month expiration, then every 500 points, and then every 1,000 points for the farther maturity, for the more distant maturities. Then on the left side, we have the calls. On the right side, we have the puts, and typically we have the best bid and the best ask in the book, the volumes, the open interests. Sometimes with some platforms, we have the Greeks, something we will speak of later on during the course, and other information. So far, let's just focus on strike prices and the bid and ask of each single strike price. Look at the background. Some options have a light blue background, some options have a white background. Why is that? Because the ones with the light blue background are the in-the-money options. Let's go back for a while to the payoff charts of a call. There. If this is the strike and it's fixed, and what moves is the spot price, then when the spot is below the strike, we have out of the money calls. When the spot is above the strike, we have in the money calls. If we use this information and we compare it to what we find in the chain, we could be a bit puzzled if we don't understand that the payoff is made of a fixed strike and the spot price moving. The chain is made of strike prices moving with the fixed spot price, so it's exactly the opposite. So pay attention to it and not get puzzled by the chain. This is what is written here in this sentence, and this explains why I didn't want you to read it before seeing the chain and comparing the chain to the payoff chart. Since everything here is related to the strikes and the fact that they grow from top to bottom, the reading of the moneyness is on the contrary compared to what is done on the payoff graphs. The calls that are found in the upper part of the table, a light blue background in the image on next slide, characterized by the lower strikes, are in the money. Those in the lower part, higher strike, light gray background, are out of the money. The threshold between them is the strike closest to the current price of the underlying, that of the call at the money or near the money. On the put option side, reading is reversed. Those at the top are out of the money, those at the bottom are in the money. Let's go through this again. The spot price is 17,600 points. So the options with strike prices 17,500 and 18,000 are the ones near the money. But the reading is different from calls to puts. Because speaking of calls, the 17,500 is slightly in the money. Why is that? Because the call 17,500 is a right to purchase for 17,500 something valued a little more, 17,680. So it represents an advantage. It's in the money. Not so much, but still in the money. About put options, it's the opposite. A put 17,500 is a right to sell for 17,500 something valued a little bit more, 17,680. So this right has not a real value because it is not convenient to sell for 17,500 something valued in this moment 17,680. So the put 17,500 is slightly out of the money. Not so much, but still out of the money. For the 18,000 strike price, it's the opposite. The call is slightly out of the money. The put is slightly in the money. Because to have the right to sell for 18,000 points something valued 17,680 represents a true advantage. On the other hand, the right to buy for 18,000 points, something I can buy in this moment for 17,680, is not a real value, is not something convenient. So all the calls with strike prices below the current price of the underlying are in the money, blue background. The puts with strike prices higher than 17,680 are in the money. And that's why we don't have blue background on both sides of the chain for the same options. Okay, now what we're going to do is do some mathematical calculations in order to see what the reactivity of each single option in this chain is in respect to the movements in the price of the underlying and the leverage of each and every option listed here. In reality, we are going to see just three specific cases. The case of a call 17,000, the case of a call 18,000, and the case of a call 19,000. All the reasonings we will see would apply in the same way, just inverting all the concepts for put options. But the calculations remain the same. Now, let's go just for a second to next slide and read what we are going to do now. And then we will come back to the chain and do some reasoning on it. Now, to understand the concepts of leverage and reactivity, we see some examples. Assuming that the price of the underlying moves 500 points upwards, the distance between two consecutive strikes, a movement of 2.83% compared to the initial value equal to 17,680 points. If all other market conditions remain the same, and assuming the change in the underlying happens in a snap of a fingers, what happens to the price of the options that appear in the table? This is the question we are going to give an answer to. Why do we have to assume that the change in the underlying happens in a snap of a fingers? Because if you remember what we saw in one of the previous lessons, time is a very key variable that affects option prices. So if we assume that the price of the underlying moves 500 points in one day or in 1 week, makes a huge difference. And here, what we will do is to isolate the effect of a price movement in the underlying while all the other variables remain fixed. So we have to assume that the change in the underlying happens in a snap of the fingers. Otherwise, nothing we say would apply. Now, let's go back to the chain and start with the 17,000 strike price call. The idea is, suppose that I have the expectation that the price of the underlying will increase within the next snap of the fingers. What could I expect purchasing, just to say, a call 17,000 or a call 18,000 or a call 19,000? Which one would be the best? This is basically the problem. Which option should I pick? Let's start with the call 17,000. Here I need to open the calculator and put it aside the chain, so let me do this. Okay, here we go. So let's see again what we're going to do here. We're going to see what could happen to the price of the call 17,000, to the price of the call 18,000, to the price of the call 19,000 in front of an increase of 500 points in the price of the underlying, keeping all the other variables fixed. Why 500 points? Because in moving the underlying 500 points, we can do some reasonings or on the basis of the chain. Why is that? Because in the moment that the underlying price is 17,680 points, the call 17,000 is in the money 680 points. Why is that? Because the call 17,000 gives the buyer the right to buy for 17,000 something valued 17,680. So it's in the money 680 points, the difference between the current value of the underlying and the strike price. Okay, so far? Now, if the underlying increases 500 points, what could become the price of that call, the call 17,000? Here we can do an estimate, of course, but a good one, comparing the prices of options on two consecutive strike prices. In the specific, what could happen is that the call 17,000 takes the price of the 16,500. Why is that? Because in the end, if the underlying is 18,180, 500 points higher than in the beginning, the option call 17,000 is in the money 1,180 points. This in the end, but which option in the beginning is in the money 1,180 points? The 16,500. So in the end, the call 17,000 would be in the same condition as it is the call 16,500 in the beginning. So the price of the 17,000 could be exactly equal to the initial price of the 16,500. So what would happen is this. The call 17,000 would pass from 1,370 points to 1,735 points. I am looking at the ask side, okay, because I think I'm going to purchase it. So I will pay the ask price in order to get immediate execution. So let's do some calculations. The price of the option would increase 365 points. In front of which movement of the underlying? 500 points. So how much would be the rate of replication in the price of the option compared to the movement of the underlying? 365 divided by 500 is 0.73. 73%. The option would replicate 73% of the movement of the underlying. This is the reactivity of the option. Let me repeat this. If the option replicated one-to-one the price movement in the underlying, as it happens with the futures, then the option price, the price of the call 17,000, should increase 500 points if the underlying moves up 500 points. But this doesn't happen. And it doesn't happen because options prices move according to probabilities of events. Let me repeat this because this is a very important fact, a fact which we will speak rivers of words on in the next future. The futures price reflects one-to-one the price movement in the underlying. Options doesn't. The options price doesn't. Why is that? Because options prices are related to the probabilities of each single event. Let's just stop for a while and get into more details about this. Look at out of the money options, 18,000, 18,500, 19,000. I'm talking about the calls, of course. If now we are at 17,680, what is the probability within the next 64 days, the time left to maturity, to expiry, to reach 18,000? 50%, 40%, 35%, something like that. What is the probability to reach 18,500? Something lower, for sure. What is the probability to reach 19,000? Something even lower. And what about the probability to reach 20,000 points? Something even lower, once again. So the farther the target of the option, the lower the probability to reach it. So the lower has to be the price. The same applies also to in-the-money options, because if now the call 16,500 is in the money 1,180 points, who can tell that within the next 64 days the price of the underlying will not fall and get below 16,500? So this price is the reflection of the expectation that within the next 64 days the price of the underlying will remain over 16,500. And all of this applies to any listed strike price. It is all just a matter of probabilities, mostly linked to expectations, but not just it. There is a component of expectations and there's a component of real value, as we will see in the next lecture. So far, let's stop here. So we just gave an explanation of why do not options prices replicate one-to-one the price movement in the underlying. And what we're going to see in this lesson is that the rate of replication changes depending on the strike price. We started from the call 17,000 and we're not done yet. So let's go through this again. The call 17,000 points, if the underlying increases 500 points, takes the price of the 16,500. It means it will increase 365 points. In respect with what movement in the underlying? 500 points. So the option captures 73% of the price movement in the underlying. This in absolute terms, but what about in relative terms, the leverage? In relative terms, what happens is that the option price increases 365 points out of an initial price of 1,370, which means at 26.64%. This is the rate of change in the option price. And we have to compare it to the rate of change in the underlying price, which is 2.83%, 500 points out of 17,680. So the option makes a 26.64% in respect to a movement in the underlying of just 2.83%. This means that the option amplifies more than 9 times the value of the underlying. This is the leverage of the call 17,000. So we have a rate of replication 73% or 0.73 and the leverage 9.41, more or less. What happens to the call 18,000? The call 18,000, if the underlying moves up 500 points, would take the price of the 17,500. So it goes from 795 to 1,050, and we don't need the calculation to see it's 255 points. So 255 points divided by 500 points, the movement in the underlying, makes a 0.51 or 51%. So the near the money option replicates more or less half of the movement in the underlying. This can be taken as a general rule. Generally speaking, most of the time, except for very special situations, near the money options capture about a half of the movement in the underlying. What about in relative terms? 255 on an initial price of 795 makes a plus 32%. This is the rate of change in the option price for the call 18,000. Remember, for the call 17,000, it was 26.64, and the leverage was 9.4, and the sensitivity, the reactivity was 0.73. Now, for the call 18,000, the reactivity is 0.51, lower than that of the 17,000. But as we can forecast, the leverage will be higher. Indeed, 32.07 divided by 2.83%, the rate of change in the underlying, makes a leverage 11.3, not 9.4 as it happened with the call 17. So the call 17 has a rate of change 73% of the rate of change in the underlying, and the leverage 9.4. The call 18 has a lower rate of change, 51%, not 73%, but a higher leverage. In relative terms, you gain more with the 18,000 call than what you gain on the 17,000 one. And as you can expect, in passing from the 17,000 to the 18,000 and to the 19,000, we will see again these dynamics, a lower rate of replication, but a higher leverage. Let's see it. The call 19,000 takes the price of the 18,500. So the change in the option in absolute terms is 585 minus 422, which is 163 points. Divided on 500 points, the change in the underlying, it means that the call 19,000 captures only a 33% of the price movement in the underlying. But what about the leverage? We have 163 points appreciation in the price of the call divided by an initial price 422. It means the option takes a 38.6% gain. Divided on 2.83, the gain in the underlying, it means this option has a 13.6 leverage. So the rate of replication is 0.73, 0.51, 0.33. The leverage, 9.4, 11 and something, 13 and something. So in passing from in the money to out of the money, we have a lower rate of replication, a higher leverage. This is how options prices move. Everything I just told you is written in the presentation. All the calculations are reported in the presentation. So far, that's all. Thank you for your attention.